Hi guys, I'm very excited to talk to you guys as, first of all, fellow investors. Thank you for investing with Tozy Capital and continue to put your trust in us. I'm excited for this offering. The team has worked very hard. So first, I love to thank my team, the Tozy Capital team, and if you guys are seeing how smoothly it runs and everything, it's all due to our incredible team. Uh, I'm excited to present Tozy Capital's first multifamily deal in Atlanta, Georgia. And I'm going to start it off with a quick video. Thanks, Mark, for getting those video ready when you were in Atlanta last Thursday. I'm very excited to have you on our team, underwriting our deal, helping us underwrite these fabulous deals, and helping us with asset management. And thanks, Shiv, for again moderating this panel. Can everybody see my screen?
Yes, we're good. And as you kick off, Eng, as always, friends, if you have any questions, don't hesitate immediately. Please ask your questions using the Q&A feature of the webinar, not the chat feature. That way we can reconcile the questions. Use the chat for the banter that you want to have, but the questions in the Q&A section, and I'll definitely at the right time ask those questions to Eng. Go for it, Eng.
All right. So with our typical bravado and gusto, I want to really give you guys a sense of why we love this investment, why we're investors, why we're investing in this deal. And I think this would be a great addition to everyone's portfolio. We have a lot to talk about, although not too many slides, because we really want to have a conversation. Engage with us, ask questions. As usual, we'll stick around to answer as many questions as possible. And as typical, confidential, usual legal disclaimers. We are investing in a multifamily value add deal in Atlanta, Georgia. It's 164 units, with half of the units already proven with proven renovations to produce strong cash flow. And the business plan is to value add and renovate the remainder half and increase those rents by 20%. It's also 20 down units, so it allows us to really increase our NOI pretty predictably and quickly. I'm excited to also partner with our local team, Frankfurter Group, and with them and Tozy Capital and Mark, we are providing really strong local market expertise. In fact, the combined team has 12 multifamily deals, investments in Atlanta MSA area. And with any value add multifamily deal, with any value add strategy at all, there's a lot of moving pieces. There's a lot of, it's all about execution. I have a strong confidence in our team, in our local team, to execute at scale and to reduce our renovation costs relative to how the sellers had it by 30%. We're also implementing best practice leasing strategies with our partnership with Caro Property Management, which has $5 billion of assets under management as property managers. And I'm excited to revisit one of my favorite markets, Atlanta, Georgia. Very fast-growing market and a economic powerhouse of the Southeast Americas, which is one of the strongest investment areas to invest in. With this, I'm going to give Mark a little bit to tell us the business plan.
Yep. Hi, everybody. So this is really just a summary. We're going to go into more detail about this later. So high level, I don't know if you guys have heard of the BRRRR strategy, but this is right out of that playbook. So BRRRR stands for buy, rehab, rent, refi, and repeat. Okay. There's half of the property, half of the units have already been renovated, restored, and we've proven some good rents with those. And so all we have to do is finish the job, and then we'll add a little bit to the exterior. So we'll be able to raise the rents when this stabilizes. We're going to, at that time, refinance, get you guys your capital back. And then, you know, when the time's right, it may be year 5. If there's a good opportunity to do it sooner, then we'll sell it sooner. But you know, property sale could be somewhere between year 3 and 5. We've projected it to be year 5 and this to be conservative.
And these strategic improvements, we're just going to start right away. We're going to hit the ground running. We're overcapitalizing on this so that we can have as much room to operate and get these units renovated fully at market rents. We're optimized for occupancy, 12 months renovation timeline. I believe we can beat that. I know our team is being challenged to that. Mark, you have experience with these turnovers as well. This is a very conservative estimate.
Yeah, I guess to elaborate on that, you know, there's 2 types of units here. There's about 60 units that are already livable, and you know, we just gotta update them. So that's an easy fix. It's going to be about $7,500 per unit to upgrade those, and we could do about 10 units per month. So we're thinking in 6 months we'll be done with those. And then there's 20 units that are down units. So these units are not in good shape. We're estimating it'll cost about $25,000 per unit. They may not have walls. So a lot of work needs to be done there. We'll have a separate team working on those units at the same time. So we think those could be done in 6 to 8 months.
Yeah, so concurrent business plans. And I think that for the units that are being renovated, we'll do them when residents leave at turnover.
It's a good plan right now. And Mark, you can choose to answer it when you want. An investor wants to know, why were the 20 units down?
Yeah, hey, they're not in good shape. So little history about this project. It was purchased out of the Great Recession, and the owners did not have enough cash to you know, really do everything that had to be done at that time. So they started going, they didn't finish, and they left these units just sitting there. So you can imagine, you know, units that sit there vacant for I don't know, 9 years. They are not going to maintain well. They're in pretty bad shape as a result. So this property was then purchased in late 2019, and those owners have you know, they've spent the money. They've you know, started along renovating the easier units, and that's how they've proved, and we'll talk about this more later, but they proved the rent increases with what they've started. But they also you know, don't have much more cash to put into this. So that's our opportunity. That's how we get to step in and finish the job, and then reap the rewards of finishing it.
So that's the business plan. And with that business plan, with this value add multifamily business plan, we're projecting very strong investor cash flow of 10% and an equity multiple of 1.7. This 10% is a bit elevated because year 1 and 2, we are overcapitalizing with CapEx and interest reserves, which will be released by Fannie through through the Fannie program, and allow us to essentially give that money back once we finish our CapEx. We don't want to wait though, so that's why we're capitalizing early and we're hitting the ground running. This will be a 5-year investment. Investors should expect a 1.73 return on their funds in 5 years, although within 3 years, you will have potentially received 135% of your investment back. And that will allow us to get a really high IRR of 20%. And this investment is structured with an 8% preferred return. And for many of you guys who are obviously investing with us, 8% allows us to really give you guys the first 8% while we have not returned your capital, and this is really incentivizes to achieve above average returns. Above 8% is 70-30 with no additional hurdles. And here's the investor cash flow. And there's a lot of numbers here. We're not necessarily gonna get into each detail, but year 1 and 2, elevated cash flow, 15% and 13% returns. Year 1 includes a CapEx reserve and an interest reserve that we're capitalizing as part of this investment upfront that will be held in escrow by Fannie, which will then be released once we finish our value add strategy. Renovations within the first 12 months. And then additional interest reserves will be released in year 2. Although our investment still cash flows fairly well, this will add a little bit extra boost to your year cash flow in year 1 and 2. Year 3, once we stabilize in year 2, we've proven out the model, refinance out of our bridge loan with a cash out refi, and are projected potentially to give investors 135% of their capital back within year 3. And year 5, we're projecting a 6.25 cap rate sale, which I can't find those. I would love to buy cash flowing real estate at 6.25 cap rate, especially with rates these low. So we're being conservative. Obviously, things could change in 5 years. I believe the trend is cap rate compression, more capital chasing yield. So this 6.25 is a little conservative. Hopefully we'll get more returns. But as always with Tozy Capital, we love to on the promise and over deliver.
And these are for an example 100K investment, right?
Yes.
Okay, thanks.
There's a question I'd like to address that came in through the Q&A.
Sure.
How sure are we that we can refinance in year 3 and get our principal back? Great question. Hey, we're never sure 100% about anything. That's part of the risks and rewards of investing. But we feel very good that we can do this. Part of the strategy, again, I mentioned the BRRRR strategy before. By the simple fact of us upgrading the units and leasing them up, there will be additional cash flow. And with that cash flow, you're able to refi. So some of the risks are, hey, if we can't, get the rents that we want, well, we're still renting it up. We're still leasing it up. And that means, versus right now where there's a lot of vacancy. So that's great news. Another risk is if lenders stop lending, right? If there's no liquidity in the market, well then, yeah, that's going to make it hard for us to execute on that business plan, but we'll be ready as soon as they do open up.
Okay. And since Mark, you did chime in, let's ask you the other question. You did answer it, I heard the answer, but the investor probably missed it. What is the CapEx that you're estimating to bring up the down units?
Yeah, so we're looking at 1.2 million. Oh, I'm sorry. Just for the down units, it's 25,000 per unit. We're roughly 500,000 to do those. Another 500,000 for the other units. We have some cushion in there as well in case we need to spend more. So that's great news.
Definitely all the questions will be answered, but quick, setting the stage, an investor is asking, what is the location of the property? Is this in East Point? That's correct. It is in East Point. That's right. Go for it, Eng.
Yeah, and I'll be talking about the location a little more
Yes.
as we go on.
Yeah, we're gonna probably answer all your questions with these slides. I really want to highlight the sensitive analysis that me and Mark worked on. You know, one thing that we want to highlight is a 16.25 cap rate does get our projected returns at these rates. We believe is very conservative. We believe at a stabilized cash flowing property, a 16.25 is very conservative. We will tend to see in the market, depending on the location, 5.5 is more average, 5.75 from potentially this type asset class. And when we are forecasting a 95% forecasted vacancy, which is a physical, it's a physical vacancy. We're projecting actually a 7% economic vacancy. So just for FYI, 5% means that 5% units won't be occupied, 2% won't be paying, which is, we want to be conservative and assume that. We have a lot of room to breathe. Our bridge loan is a IO loan, will give us a lot of breathing room. But once we're stabilized, we project our DSR to be very healthy, and so healthy that even if we lost 48% of our occupancy, we would still be break even. And with private illiquid real estate like this, you're not subject to market whims of it going up and down. As long as you pay the bank, you keep the real estate. And as long as we're cash flowing, we're gonna be very well, positioned to cover our debt service and pay our investors.
Awesome. I think if you can just remain on the slide, I know you've answered the question, but let's just go through it again. An investor wants to know, what occupancy are you planning to achieve at stabilization point?
A stabilization point, it will be 95% physical, 93% total occupancy, economic occupancy.
And I think you've sort of answered, but I'll still ask this question. What is the expected percentage of occupancy of the units? I guess it means during stabilization, unless you read it otherwise.
Yeah.
And the investor, please ask the question differently if I misunderstood you. Go for it, Eng.
And just an eye chart here, financial summary, repeating a little bit of what we talked about with some additional numbers. Total project cost, $19.5 million. And I want to highlight just a few numbers here. We and our affiliates and our operating partners are co-investing $1 million or 15% of this investment, which is a total of $6.7 million of equity, $5.7 million from the investors, $1 million from the sponsors. And I want to highlight two additional numbers. CapEx reserve and interest reserves are being pre-funded and overcapitalized essentially, so that we can start on the project as soon as we own title of it fairly quickly. And then that will be provided back to investors within the first 2 years.
And that was one of the questions that was asked, and you've just confirmed that the sponsor, Tosi Capital, and its partners in this are putting in 15%. Is that right? 1 million. Okay, awesome.
Mark, can you tell us about this value add strategy? How are we going to achieve these IRRs and these returns?
Yeah, so this is a big part of the business plan. You can see in the top left, this before picture, that's what the units look like right now, the unrenovated ones. So you can see, they have the white appliances and, pretty boring countertops and cabinetry. So the current owner has been spending about $12,000 per unit to update these, which is not, it's over market to make the updates. With our connections in Atlanta, and then the bulk that we'll be putting into it, we're able to do it for $7,500 per unit on average. So easy to do. Again, that's where we think we can do 10 per month. Now, the next two pictures, that is what it looks like on the down units. All right, they are a mess. There's no walls. You can see the brick. You can see through walls. So, you know, what we'll do, again, we'll be working on both of these simultaneously. And one great thing about this project too is most of the down units are in the back of the property. The back of the property is beautiful. There's a bunch of trees, you know, I mean, even the trees, if you're not from the South, um, you know, trees have vines going up and down it. And so, yeah, I don't think we have a picture on here, but the trees are beautiful back there. We're gonna, you know, add a pergola. So those units, we think will actually get more than the average 250 per month per unit, just because it's so nice back there. So very exciting. You can see, you know, these are the pictures of what the property looks like right now, including the newly renovated units. The pool was recently updated, but we'll do a little bit more to it to make it a little nicer, add some better furniture. Number one, so the picture at the bottom in the middle, that's the leasing office. Right when you come in, that's the first thing you see. A big part of that in the back on the right is what will be a gym. None of the competition has a gym, so we'll be the first one, and that's very attractive, I think, for our residents. And so in the first 30 days, we're going to have the Maple Haven. We're going to focus a lot of time and attention on this clubhouse. We're going to update it. So, you know, you always want your clubhouse to be at least one step nicer than the rest of the property. So it's going to look a lot nicer. And we'll have the gym ready all month one. At the same time, we're going to be in our rebranding strategy. So by the end of the month, we'll have our new website ready with its new name, and we'll have the new signage on the building as well. So day 31, this should all be in place, and we're off to the races.
Yeah. So even though you guys are investing in Maple Haven, this property will be known as Maple Haven for too much longer.
Yeah. So yeah, these pictures kind of summarize what it looks like right now. You know, you can't really see the roofs, but 4 roofs have already been updated. We need to replace the rest of them. So that's all budgeted for.
Yeah. And part of the value add strategy is to introduce fairly simple and, you know, standard operating procedures of leasing. You know, one thing that one of you guys asking is why is the owner selling? They're not they're more like flippers. I think that's the way that I would like to classify the sellers. They're coming in, they're really good at renovating, they're really good at construction, but they're not specialized in managing or operating these communities. And we're going to partner with Caro Property Management to bring best in class property management service. And we'll introduce RUBS, which is not being introduced now. We'll increase revenue and NOI through that as well. And our comparable rents are very favorable to the average area. And this is all properties within a 1 mile radius of the subject property. I'm highlighting the first 2 bars on the left as our unrenovated units and our renovated units, and where we believe, obviously, our unrenovated units will go up. As Mark highlighted, those 20 down units potentially could even fetch a bit higher as they're secluded in the back. And in a slide or 2 later, I'll show how nice this seclusion is. And Mark, you've went to some of these neighboring properties. What's your feel for this area and our competition?
Yeah, so you know, this right now, I drove around to a few of the different competitors, and those look like they're in decent condition. Ours will be a little bit nicer, and you can see that their rents are, you know, as much as what we're currently getting after it's renovated. So that was very encouraging. In addition, I drove to some of the other properties that our partners are operating, and same thing. Those are all very well occupied. They're stabilized. And so, you know, we feel very confident that we can raise these rents from the current average 805 up, you know, to or above the 1,050 level. So that's a 250 per month rent increase, and we think that that is achievable, and we'll be shooting for more.
Yeah.
So
go ahead, sorry.
Yeah, before we get to the location, Mark, a couple of questions. Is that okay?
Well, let me finish going through, I guess,
Go for it.
value add strategy.
Yep.
Yeah. So another thing that's happening, with the current owners is that they are not being aggressive on marketing. They're very passive, and so what we're going to do here is be aggressive. Number one, we're going to start internally with the current residents. We're going to have, twice a month events for the residents. One of those events will be much bigger, and then the other will be a little more low key. But the community development, I like to call, is helping to close the back door. That means it's less likely people will move out. In addition, having that community feel is very good. And we think that that'll help get some word of mouth. With social media, the current owners are not posting online, so we're going to be, posting frequently and engaging with prospects. So very excited about that. All right, did we have some questions?
Yeah, before we go to the location, a couple of questions. You mentioned half the units were renovated recently, which are occupied now. Are the non-renovated units not livable, thus empty, or actually are you renting, or are they being rented at lower rents?
Yeah, they're being rented at lower rents. So, that's where we got that 805 average.
Okay.
We've had 64 units that have been renovated, 60 have not, and then plus another 20 that are just down.
Yeah, I believe 84 units have been renovated.
Oh, right.
And then the 60 units not renovated, obviously, we'd rather have somebody live there and rent there, paying rent and, essentially being vacant. But it actually makes it easy that there are 20 vacant units that we can just renovate, allows us to just go move quickly with these project management value add procedures. Doing one at a time, one by one, you lose a little bit of economies of scale. So we get a little bit more scale benefits by tackling those 20 units concurrently right away. I love this location. I think it's a very interesting location, and Mark will give a little color. I like that essentially this property that we will be owning together. We own this road. We own stop light. That light is for this community, and it really does feel special. It feels like a secluded green community. And it's doesn't have any in-road traffic in and out. It's just for this community. So I think there's more we could do with this, and I like how secluded it is. It gives a little bit of ambiance that isn't available in other apartment building communities in this area.
Yeah, we're really buying the whole neighborhood.
Mm-hmm. Yeah,
so we get to control it.
And part of our operating partners, specialty is really developing a community feel. We talk about community here a lot. I really think it's important. That's why we are reserving $1.2 million of capex to improve the community public areas, so that we can elevate ourselves to even just market rents. So these are our conservative forecasts, where we believe we'll get better, but at the very least, we have data to prove these are easily achievable, even within our 84 renovated units.
To all the investors, quick one, Mark. For people who are new to this kind of investment and all the other questions, we are definitely going to get into distributions, when and how you're going to get the distributions. Just be a little patient. Let's go through the location and we'll go through all the money aspects of it definitely today. Go for it, Mark.
Yeah, so this location, as Eng was saying, I think it's a fantastic location within East Point. Number one, you can see on the right part of the slide, those are single family houses, and there's not much of that in the neighborhood. So we are right next door to one of the few points with single family housing. On the left side is a brand new just built active adult or a senior living community. It is nice. I tried to go inside. They wouldn't let me because I guess they're still under COVID protocols. But I was able to peek in, and it's definitely helping to elevate the neighborhood. But let's look at the bottom of the screen here. You can see where the road hits that access road, and then below that, the bottom line is the freeway. We actually have our own stoplight. Easy access to the freeway means easy access to jobs. If you can go to the next slide. So you can see the proximity to the freeway. We are minutes from the airport and headquarters for Delta, biggest airport in the US, if not the world. And then also easy access to downtown with a lot of different headquarters, Coca-Cola, UPS, etc. So this feels like its own neighborhood. We get to control the neighborhood and how it feels, and what types of tenants we want in there. We're gonna be very active in reaching out to the businesses nearby and letting them know that we have a nice, safe place for people to live. Also close to this star, less than 2 miles away, is the Tyler Perry movie studios. So we're just, again, very excited about how, where it's located and how easy it is to get around.
Yeah, one of the biggest new industries in Atlanta is Hollywood. It's like Hollywood East now.
Eng and Mark, I just request you to go a little bit quicker because we have lots of questions. Okay.
Yes.
But take your time, but just.
I'm not gonna read all of this. When you invest in real estate, you should invest in tailwinds that help propel essentially two critical factors. You want people to live in your apartments, and you want a lot of people to want to live there, as well as you want increasing rent prices. Population growth allows that. Job growth allows that. These two tailwinds will help us in this investment in this MSA. And so Atlanta is one of the fastest growing population areas in the Southeast, which is one of the strongest regions in America in general. We have a lot of diversification of employment, so we're not single tied to any one industry, like some cities. We actually have a fairly good technology hub. There's a lot of universities. That's a great engine for innovation and job growth. And of course, for any young professionals, this is a very educated workforce, and it's very business friendly. I love living in California, but I probably will not invest in California for real estate because I love business landlord friendly laws where we have a little bit more ability to be nimble. So these are all the reasons why I love Georgia, and me and my partners own nearly, I think, more than a dozen multifamily apartment buildings in this MSA area. And I want to highlight that one thing that we're allowing our investors to do, which we haven't done for our previous multifamily deals, is a tender exchange option. This is something that we push for from our partners and our lenders. It is more complicated, and that's probably why most folks don't typically allow this. But if you're interested, please act quickly. By Shiv, end of next week is when.
That is correct. By next Friday, we need to know exactly all the people who want to get 1031 exchanged into this, because we are very, very tight on closing. So we need to get your names there. So next Friday, drop dead date.
Yeah. And so typically our investors will invest in an LLC. We do have an LP here, but it's very similar, limited partnership. And investors can invest with cash, self-directed IRAs, solo 401ks. And so with the tender exchange, we'll all be co-titled, allowing our tender exchange investors to take advantage of all the tax benefits of that exchange.
And Folks, since I'm helping out a little bit on the 1031 side, I just want to add, and I'm sure Eng will also do, is we have already so many investors coming in with interest in 1031. So if you are interested in bringing 1031 exchange, please reach out to Eng and Ryan immediately, because there's a lot of work and we don't have too much room. We have to leave openings for other investors as well. So 1031 folks, please get in touch with Eng and Ryan as soon as possible so that we can start factoring you in. Go for it, Eng.
So we obviously opened investment today, and I want to highlight this investment timeline because in a previous multifamily value add investment, we essentially oversubscribed within 2 days. In fact, by the next day, people were on the waiting list. So I want to highlight that I really wanted this investment to be investors first. I really want you guys to have early access, exclusive access to Zio. If you're interested, please take action as soon as possible. We will be providing the link and an email. Potentially, you guys got the email already, or we'll be getting it in the next few minutes with the link to investment. Funding deadline, investment deadline, subscription deadline, beginning of August. We're closing the property end of August, and we're targeting our first distributions for the first full quarter of operations, Q4, which we'll target in January. Although we'll always try to over deliver. And K1s provided in March, and excited to see how much cost segregation allows us to pass on really nice bonus depreciation benefits to our investors. Typically, in our previous real estate value add multifamily deals, depending on leverage, we've seen is 40 to 60% of your cost basis as a K1 passive loss. But I do want to reiterate the sort of sense of urgency. If you guys are interested, I know I'm generally the kind of person who says, invest, take your time. Yes. But I also don't want to disappoint you guys. I would prefer giving our investors first dibs at this. I've been told by Ryan, we already have 3 million subscribed to our investments or reserved for our investments. In addition to our million, we're well halfway over 60% over already subscribed. So I just want to point that out.
So Eng, since you did bring it up about timelines and everything, what I'm doing for the benefit of the investors is immediately right now in the chat box, I've shared the link to the offering. We just went live with it. Please copy the link. Don't do anything about it. Pay attention to the webinar, but we're already sharing the link with you. At 7:05, you will also, or after this webinar, you will also get an email. This is for investors only. So if you share this link to a non-investor, they will not be able to see the deal. They will not be able to invest in the deal, although they can see the deal. Go for it.
Yeah. Okay. I didn't mean to fade myself in, make myself special. But the team represented by me and Mark on the Tozy side, you guys know us. We bring a wealth of experience in multifamily, value add, and asset management. But I'm excited to partner with Frankfurter and Yakov. I've come to know him over the past few weeks, and we knew each other we and Shiv invested with Frankfurter, so we held them in high regard. They've also in the senior living space, so it's a small community. They all kind of know each other. And we're excited to have Brian, who Mark met and will be partnering with on the asset management and execution of this value add strategy.
There's a question about what I've done.
Yeah, let's go into the details so that I can bunch together the questions, right? Let's get to we're definitely going to talk about all the questions. Let's get to the easy ones first. There is an investor who is new to this kind of investment. Am I going to get paid out now, or is it going to be at the end, is the question. Eng?
Yes. So we'll be providing quarterly distributions. There was a cash flow table that highlighted year 1, 2, 3, 4, 5. year one being 15%, two being 13%, three being 106% annually of your investment basis. So you invest 100,000, you would get 15,000 in the first full year. We will be providing quarterly distributions and quarterly updates to our investors. And this will come after the first full quarter of operations. So you won't be waiting till the end of the investment. You won't be getting it next month because we still need to close on the investment. We still need to, leverage our capital to facilitate the rebranding, the value add renovations, and kickstart all these things. The great thing about this value add renovation as well, these 20 units, we already permitted for 20 units. We don't need to wait for bureaucratic permits or anything else that could slow down any projects. When you're renovating interior units, which is, it's much faster to do. We're in fact getting all these things ready to order so that we have it. Very happy that lumber prices are going down.
Awesome. Now let's talk a little bit about investments. An investor is asking, what is the investment amount to be a certified investor with Tozy on this project? Now, this is a 506B offering, which means most of the investors in this deal would be accredited investors. But there is a limited number of non-accredited sophisticated investors. The exact number is 35 that can participate in this deal. So if you believe you're not an accredited investor, but would like to partake in this deal, please reach out to Eng and Ryan immediately so that you can be one of the first 35. And Eng, what is your take on the investment amount?
To be certified? Well, you mean the minimum investment?
Minimum investment.
Yeah.
That's what.
So we're putting 100,000 on minimum investment, which is reflected in the investment room. But as always, I believe in long-term partnerships. I want to be as common as possible. Just let us, if that's we can be flexible. So just talk to us. But we will be prioritizing investors at larger check sizes because we do believe this will sell out pretty quickly. And I just want to have our administrative team have little lighter burden. I want to highlight our experience. Tozy Capital and especially Frankfurter bring a depth of experience managing multifamily assets and especially operational and value-added execution. So there's a lot of big numbers here. If you know me, a lot of this isn't Tozy Capital, but at least a fairly significant portion is. And I'm also excited to have Mark join us, he has a lot of experience with asset management and helping with acquisitions as well. But we're also going to be leaning on our partners at Caro Property Management. They also have a lot of big numbers. They have a lot of assets under management. And especially, I really like the fact that they focus on Georgia. They have a lot of best-in-class acquisition and asset management experience. It's always good to have a partner that is in the game of investment as well, not just a service provider for property management, but somebody who likes to acquire things and invest in things because then they understand our business plan and executing. They will be hand-in-hand partners with us on executing our value-add strategy, as well as maintaining and maximizing our rent collection and occupancy. With that, we are at the end of the presentation and we'd love to start answering questions. I will leave this slide here. I don't want to think.
Yes. Can you just leave it on screen? That way people can just read through this. Thank you so much for that. That's nice that you have an FAQ slide. Thanks. Let's get into all the 13 questions. I'll alternate between Mark and Eng so that you guys get a breather as well. Eng, this one's for you. You said first year is going to be around 15% of distribution. Will it be evenly divided through the quarter?
No.
Each quarter? Okay.
No, we'll be providing our distributions when Fannie releases the funds. That will happen after we complete our initial CapEx spend. We will show them proof of spend and completion. They will release that. We will then provide that to our investors as soon as possible. most realistic and conservative expectation is at the end of the year. So there will be a big lump sum payment at the end of the year and of the full investment year.
Okay.
But then starting in year 2, we should have a quarterly payments.
Yeah, well, in the first four quarters, we'll have quarterly payments as well. It'll just be a little bit, it won't be as much as sort of the last quarter of this investment, or the fourth quarter of this investment.
Yes, but the first distribution will be there in early January 2022 for Q4 of 2021. That's the first quarter of full ownership. That's what I'm reading, right?
Mm-hmm.
Mark, this one's for you. An investor asks, just interested with the gym going on, who's the typical current resident? And is there going to be a shift on who this is going to be marketed at, seniors versus students?
So no, this is going to be marketed intergenerationally. The gym, the good thing about it is attached to the leasing office. It's not a separate building. And so we do have, we'll be able to make sure that we know that residents are using it and not strangers. But yeah, I mean, the marketing is really just for healthy lifestyle. People, there's not many gyms in those neighborhoods. And so to offer a property with the gym, no matter what the age is, you can come in and use it if you're a resident.
Yeah,
awesome.
And one of the things I know about properties with gyms is, well, it might not be the most leveraged and utilized thing, is one of the best marketing strategies to get new tenants in.
Yeah, to that point, actually, having amenities like the pool, people may not use it, but knowing that they could might be enough to make a decision.
And then would you mind going to the slide in which the numbers were there, the big numbers, the returns and so on, cash on cash? The one with the smaller circles that you had. Yeah, thank you so much. It could be there. An investor asks, it's your favorite topic, Eng, so this one's for you. What are the tax benefits on returns each year, and what bonus depreciation can we expect?
So the full investment basis purchase price is shy of 14 million, 13.6, I believe. We will do a cost study to take advantage of the non-land value of that. That will and will provide that as a K1 benefit. We will also capitalize the depreciation benefits of the CapEx expenditure on ongoing basis. But the first year will be the biggest. And without knowing all the exact numbers, we'll give range of typically 40 to 50%, potentially probably higher of your investment basis. So if you invest $100,000, you could be looking at a $50,000 K1 loss the first year. Now, if you don't have any other cash flowing positive passive investments, you wouldn't necessarily be able to leverage that right away, but that carries forward indefinitely. Second year, you would still get additional depreciation benefits, but you will also that'll be offset by all the profits and returns. Although I would note that the first year return of cash flow of 15%, a significant portion of that is return of capital, classified as return of capital. So that is a non-taxable event because that's just reduction of the capital account, which is the CapEx and interest reserve release. And in year 2, there's also an interest reserve release, giving us this higher cash and cash in year 1 and 2.
Awesome. Mark, you've been answering a lot of questions. So there's an investor who asks, hey, who is Mark? What are his qualifications and experience with projects like these? So go for it.
Yeah, fair question. So again, new to a lot of you guys, glad to be here. I was the CEO, CFO, and actually for about a year, also the COO of a property management company. We focused on senior living, but had some multifamily as well. All in all, we had 32 properties with 2,600 units in Texas, Florida, and Oklahoma. So, I love it. I love being at the property level. I definitely understand, what it means to have, a community of people, and it's much more than just tenants paying rent. We have residents, people who live with us. And so, yeah, in addition, I'm owner of a couple limited partnership for some 400 plus multifamily as well. And I've been a investor in real estate since 2002.
Thanks, Mark. Eng, the next question is for you. This is a little more macroeconomic. Interest rates are expected to increase in the relatively near future by our current administration. Let's see. This may be done incrementally or not. How do you project this will affect your refi efforts, property value, and investor return? Fair question.
Interest rates increase because the central government and Federal Reserve are scared of inflation. Inflation is going up. Inflation means inflation of assets. This is an asset. If interest rates increase, that means potentially, more likely, it's very highly correlated to this asset price going up. So in general, outside just this deal investment, in real estate investors, if you're thinking like an investor, should not be afraid of interest rate increases because it's almost always tied to asset appreciation. Now your daily monthly cash flow might be a little bit more limited, but equity will be higher. We are projecting a year 3 refinance of Mark, I believe it was like 4.25% rate on a stabilized rent property. Correct me if I'm wrong, potentially 4. That is conservative and very relatively high for this market. It could be that, but I think we will, for our first 3 years, very sure, very positive of these returns, and year 4 and 5, obviously further out, higher interest rates could reduce that.
I just want to be mindful of the time. To all our investors, we will definitely stay back and answer all the questions. But for folks who had only budgeted 1 hour of their time, we are coming close to the top of the hour. I just want to make some observations. First, the link I've provided to you, the deal is live for investors and investors only. You can go ahead and make your investment request if you want. You will also be getting an email shortly after with the same information, but please wait for a couple of hours for this recording to actually complete. We are going live because of the demand very quickly without the recording, but later tonight this recording will be available and we'll upload it to the deal room as well. What I heard Eng tell me is that you already have $3 million of subscription, and on top of that you have folks coming into 1031 with 1031 exchange. Am I correct, Eng?
Yes.
Yeah, so if folks are interested, no pressure, but reach out to Eng and reach out to Ryan quickly. That's what I wanted to put it out there. The deal is live right now. Thank you so much for people who might have to leave us now. Let's go on with the questions. Mark, the next one was for you about what are the local school ratings in this area?
Well, these types of deals, they can't, it's not a perfect deal. This is one thing that isn't ideal for us. We're excited about it because of the job growth, the proximity to jobs. The schools are not great. They're in the 3 and 4 range. But at the end of the day, it's typical for the area. So we're just gonna really sell it on the jobs.
Yeah, and I want to highlight that, yes, as a parent who's looking at potentially private school or figuring out what the best school to give Aiden, I can definitely afford it. Not everybody can. We're not investing here to live there. We know this is workforce housing, C/B- community, and I think we're cognizant of it, but we want to make it as best of a community as possible. The market rents for this type of demographic does support it very easily. And I'm very excited that, it's also something that is mindful. You want to have these good fundamentals, but ultimately job growth and population growth helps drive a lot of these demand.
Okay, and the next one is for you. Have you removed contingencies, financial and property inspection?
So we are well into due diligence. In fact, we've done our due diligence for 2 months, even though Mark just visited last week. Our partners have been very diligent on it. We are in fact finalizing our lending right now, past signing up a last minute paperwork with our lenders. And as soon as we confirm all of our TIC investors, 1031 exchange investors, confirming that as well. So as far as contingencies gone, we'll be clearing our due diligence period very soon. And at that point, all these contingencies are removed. Financial contingencies are not removed because obviously we want to make sure that we can finish this loan. But we've worked with Arbor on almost every deal. Frankfurter has as well, and we're very confident.
Got it. Mark, the next one is to you. How's the occupancy rate T12 last 1 year?
Yeah, so they got this and it was like 20%. It was pretty bad. They started with their renovations and they've actually got it to about 70% right now. So we're taking something that is going to be, there should be a little cash day one, of course, with all of our renovation plans. That's going to be our focus initially, but yeah, they got it to about 70%.
And I think we're at 10 net monthly move-ins, which is amazing for top size of this. I'm expected we'll be close to 85% by the time we close.
Which is probably a good segue into the question an investor asked. I mean, both of you can take it. Research shows that 27% in the area of East Point is vacant. Why would 95% occupancy be the target?
Is that correct, Mark?
I'm sorry, I missed that.
27%
okay.
vacancy.
Yeah. The investor is asking, research shows that 27% of, I don't know what it is, I would say units in the East Point area are vacant. Why are we talking about 95% occupancy? Is that realistic?
Yeah, so great research. The units that we're taking care of are leased. So with the with our partners at Frankfurter, again, I drove the competition and those were leased up, those were stabilized. We drove around to their properties as well, and also doing very well. We toured one property, actually as a set of 3 properties owned by the same group. And actually we have some inside information on that group. He used to work for that company. And there's like 30 owners, and we're talking, probably 1,000 units here in East Point. Those owners couldn't make decisions. They stopped. They haven't. They stopped doing renovations. They ran out of money, and then they couldn't make decisions after that. So really, for the last 8 months, it's been sitting there. There are some tenants actually living there, but for the most part, that is probably going to be a big part of your 27% average. So we feel comfortable that we're able to lease it up based off the current performance of the property, the competition that we're looking at with the mid thousands rent, and the other properties of Frankfurter in the area.
Yeah, and some of the properties that are professionally managed, they're running at very high occupancies, and compared to our really secluded community feel, I think we have so many potential advantages that we're going to optimize for occupancy first, but once stabilized, once we're fully renovated, that's when we start pushing rent. And our model is baking all that in.
And I just want to add my opinion as an investor. I invested 2 properties in and around the area, not through Josie Capital. See, sometimes research can be misleading because every city, every area, every metropolitan area has got its own small pockets where things are really good. Like Mark was talking about it, I've researched this property. The access to the freeway is actually a very, very big plus, and the access road is. So sometimes research always talk about a macro region and not about the micro benefits of a particular property. But these are the kinds of questions which definitely we love. And the answer for the following question is not going to be good for the investor, but an investor asks, can you reinvest the distribution? Because it's high cash flow, right?
Yeah. So we're happy to find other investments for you. We will not be able to reinvest in this deal because taking upfront capital, that will likely be the only capital we'll ever have. We are over budgeting for everything. But I like that question. I hear that question quite often. In our Bitcoin mining investment, for example, we are providing 8%, likely 8% now, first month returns, and we'll be providing all of our investors the option to reinvest that into a second deal. But we'll always be evaluating, listening to you guys. I really appreciate comments like that and feedback like that, how we can better serve you and provide really nice, predictable investments to help you achieve your goals.
Awesome. Thank you so much. Mark, we have 10 more questions, folks, and all of them are actually very interesting. So please stay back. These are very important questions for everybody. Mark, this one's to you. What percentage of the 84 current renters? That's not correct, right? We have more than 84. 84. Okay. What percentage of the 84 current renters are on Section 8 currently?
Well, none. There's no Section 8 here. There are 7 leases that are part of a, I guess, like homeless reentry program. So I believe I answered someone earlier that there were none. There's actually, I did a little research and found 7 for a reentry program.
Got it. And an investor asks, am I correct? So the purchase price is 19.5 million, less 12.5 million, which is the first mortgage, the senior debt, with 35% down. The down is 6.7 million. Am I correct? So is it 65-35?
Yeah, we're doing a 66% loan to cost loan.
Okay. Certain investors are asking specific questions which are very particular to their use case. So I'll try to hold back on that and ask the more general questions first. Mark, how does it happen? Those 60 leases, do you just terminate them at one go, or does it happen in phases?
No, we won't be terminating them. They will have rent increases though. It's going to be, not quite all the way to a renovated unit, but it's going to be something that, they'll have plenty of notice so that if they can't afford the rents, hey, there's other units in the area.
And so both outcomes of both outcomes of rent increases allows us to get a favorable outcome, right? They're either going to stay and pay higher rents, which is great for us, or they're going to leave and allow us to renovate and then achieve higher rents.
And you're getting quality for the rent increase. It's not like we're going to raise their rents and keep it a poor property. So,
yeah. And this one's for you. What concerns do you have about delinquent rent payments and due to COVID? Any other rent roll risks that spring up?
So the really interesting thing here is these are relatively new rent rolls. There has been some bad debt in our observable T12 that occurred early on, as typically what happens is delinquencies happen fairly early on in somebody's entry point. At this point, we are getting newer tenants that doesn't have sort of the same potential makeup as when people were filling up in early and deep into the pandemic. We also, it's not like all these new tenants also have. I think generally the newer tenants have better economic viability than the previous ones. As those circumstances changes, we are always having a very stringent check financially for our tenants to be able to stay with us.
All right, 6 more questions to go. And this one's for you. No, you did this, so let's go to Mark. Mark, are the vines at the rear from neglect, or are these fancy decorative vines for maybe freeway noise?
Yeah, so vines on the trees is just, that we're going to have that. Anything on on the buildings is neglect. Again, we feel very significant budget for both inside and out to take care of all that. We spent a lot of time in due diligence and pricing out what we need to do. So I feel very confident in that.
All right, questions are starting to come in. Okay, Eng, this one's for you. From what I'm learning, so it's going to be difficult to walk through this. So maybe this person, this investor, you're better off getting online with Eng or Ryan or with me, and we'll be more than happy. But I'll still ask the question for everybody's benefit. From what I'm learning, cost segregation depreciation comes back to bite us at the time of sale at 25% depreciation recapture tax. If possible, walk us through a 100K investment and how much tax will we pay on the capital by year 5? That depends, right?
And also, I think bite us, right? I think the fact that you're first getting a tax deferment, my 401k is going to come bite me, but because I have to pay taxes in the future. We're paying taxes also at a lower rate of 25% versus the marginal rate. For the most part, within this property investment, on the projected cash flow, if this was on investment you have for the first 4 years, potentially even cash flowing into the 5th, I would suspect that if this was on investment using this K1, you would be able to offset all this cash flow, all 135% of return, which 100% of that is return on capital, so don't pay taxes on that, and 35% of operating cash flow, which would be taxed, I suspect, for many of you guys at a high marginal tax rate, which then would be offset by depreciation, and year 5 would be recaptured unless there's a tender exchange for this potential LP.
So I want to give both of you a little bit of a break. Just a breather. So a couple of easy questions that I can take. Meanwhile, you can look at the other questions as well. An investor asks, I see 8% preferred return and 10% cash on cash. Does this mean we can potentially get 10% or more? The 8% pref is what it is. You will be given the 8% return first before any other activity happens, like return of capital or the sponsors getting a promote. That's all the 8% pref return means. The first focus is to give you 8% of your money as a distribution. On top of that, as we go through other events, as we have more cash flow, yes, here we are projecting you're going to get more than 8%. We are saying on average, it's a 10% cash and cash. So yes, there is potential to get more. Absolutely. Definitely look through the details. That's what it means. But pref will be targeted first. Another question. And did you have something to add?
Yeah, I also want to highlight that, me and our partners, Frankfurter, are really going to help prioritize our investors first. One thing that we're doing is typically when you do a pref, it will be on the capital basis. And because we're going to be returning capital in the first year, second year, and third year, that 8% pref will be reduced. We're taking it on the investment basis, which means that we'll be providing the full 8% of your investment, even though we're returning capital throughout the first 2-3 years. So this will have a heightened return to you as opposed to a potentially more traditional waterfall model. A little in the weeds, but sorry, Mark, you went after that.
Yeah, it's not typical. So this is very generous, favorable to the investors.
Did you guys just say that it will be an 8% pref return on the initial contribution till all capital is returned? Okay. Normally it's on whatever is remaining, right? What they say is unreturned. Okay, that's fine. Yes, it is getting into the weeds, but mathematically it's better for investors. Okay. For people who have questions on that, definitely reach out. Mark, this one's for you. Any big employers in the area?
Yeah. Again, when you're looking at the airport, Delta Airlines is right there. Atlanta is fantastic. They have a lot of different Fortune 500 companies. So downtown, there's Coca-Cola, Home Depot, UPS, AT&T, Chick-fil-A. There's a lot, and it's diverse. So Those are the big ones. There's a lot of small ones. I mentioned earlier that Tyler Perry's studio is less than 2 miles away as well.
Okay. Eng, a question for you. I've heard you mention a bridge loan and funds being released by Fannie. Can you explain, please, about the senior debt here?
Yeah, so we're taking a bridge loan because it's a value add investment. We need 2.4 million to do the renovations capex, but Vanny wants us to capitalize, essentially pre-fund some of that capex reserve, not the full amount, and interest reserves for the first 2 years of interest payments. Essentially, they will be held in escrow. The first year, we'll release the capex reserves as we finish the capex and the renovations. So that's $750,000, which we will be raising, will be sent back to investors. And this is a requirement to get this really favorable loan, bridge loan, because you're essentially getting a $12.8 million loan on a $13.6 million purchase price property, because we're proving that $2.4 million will get us to a $23 million exit price property, which is very predictable. Remember, Fannie is a very stringent underwriter. So we're always, while we believe we're good at underwriting, we always have third parties, lenders who are the ones actually giving us a significant portion of the capital, and they're doing all their own due diligence and helping us evaluate these. So interest reserves will also be $544,000. Half of that will be given the first year, half given the second year. That's how the first 2 years are slightly above expectations of 15% and 13%.
All right. And to this investor who's been really patient, they asked this question way back. I just wanted to even out the questions, Mark, this one's for you. With extensive construction ahead for the down units, would it be hard to rent and retain residents? It is hard to bear over 1 year of construction noise.
Yeah, I don't know if we could put up the slide of the property, but it's a big property. You know, again, it's a whole neighborhood. So construction is going to be in bits and pieces throughout it. It's not going to be, you know, you're not going to live right next to construction for the whole year.
Yeah, it's a backprop buildings, and it's fairly isolated. This lot, it's actually very large, 9 acres, and so very large premise property. So lots of really good secluded areas, feels like a very quaint neighborhood itself.
Yeah, and then if there's a lot of hammering, that's going to be done in units. So you'll only really hear it if you're right next to the unit. It's not going to be much, you know, it's not a full ground up development, right? It's just internal inside.
Mm-hmm.
Yes, unfortunately, guys, the questions are not reducing, so we'll keep going. So let's see what's the next one, which would be common. We talked about that. An investor says, is it accurate to summarize? Is the accurate way to summarize this upside as number one, the current rents are not competitive. Number two, there's a renovation opportunity. Number three, there are 20 down units that you can bring back up. Basically, it's been managed poorly. Am I right? Yes.
Yeah. Yes, it's being managed poorly, but I think the attention isn't necessary to, from the seller's perspective, you know, they're not in it to run it as maximum as possible. They're in it to flip the units and renovate it. They're proving that model. They've got, and that's their business model. Everybody has their own business model. We can do that as well. In fact, we're doing it at a better scale and better costs. But you know, we're taking it with professionals, with a Frankfurter group and Hero Management to help facilitate this execution.
Actually, let me piggyback that with another question here. The question was, if the project cash flow is positive through 5 years, is there a chance to keep it beyond 5? Our business plan on this one is to really keep it 3 to 5 years. You know, our exit strategy is to stabilize this and then sell it to, you know, someone who does want something that they don't have to put a lot of work into. It's already stabilized and cash flowing. So, you know, another goal of ours is to continue to provide you with additional opportunities so that when you get another capital event, that we'll have another option for you at that time.
Okay, awesome. If some of these questions have been already answered, just to be mindful of time, I'm pushing them till later, but definitely look at the recording and those questions. Like, for example, what capital improvements do you anticipate? We've clearly addressed that. So we'll come back to it if you have time. Otherwise, definitely watch the recording. Mark, the next one for you, I'll give you a couple of minutes, a breather to answer that. Why are the sellers selling? Meanwhile, let me take a couple of quick ones. Oh, Eng seems to be fresh enough. On sale.
Shiv, I think we just answered that one. You know, they're flippers. They're not in it for the long run. They don't have much more cash anyway, so they want to cash out.
Okay. And this is a classic commercial real estate deal with a promote involved. On sale, actually, it's not on sale, even before sale if it's applicable. What is the GPLP percentage? And does it change if it's a 3-year option?
No, it's 70-30 above 8% pref. So after the first 3 years, we expect our investors to receive the full return of capital. At that point, the 8% pref gets removed, which won't happen to the 4th year, which will have a little bit lower cash flow because we'll have a bigger, higher debt burden. And then the 5th year sale will have that profit because investors will have been made whole and then some. The profits would be split 70-30 with no additional waterfalls or catch up.
Got it. At the end of year 5, will I have stake in the property? As long as this partnership owns the property, you will have stake, but once it's sold, you will not have stake. That's the answer to the investor. This is for you. Aren't we getting better returns with our PEG fund investment with TOSI with 12% return taxed at a longer tax term gain than this one?
Hey, we're getting a lot better returns with Terraso and Bitcoin mining as well. I think this is a classical tax advantage real estate investment.
Exactly.
20% IRR is so, for me, it's what I'm used to. But for the market and especially in Atlanta, it's hard to find. I think this is we'll need to work hard to get this, execute on it. I have very high confidence on it. But classical tax advantage real estate, which most other strategies do not offer that same thing. And with real estate, there is that relative safety of that principle, of that basis, right? People need to live. They're not making more of this. It's generally a very relative safe investment, and the cash flow returns, well, slightly less than PEG fund on cash flow. Return of capital year 3 really helps increase the IRR.
Okay. Guys, 65%, I think we touched on this. 65% stabilized occupancy sounds, sorry, 95% stabilized occupancy sounds high. Do you have, or have you done a current rent survey of the area? How low are the current rents? What is the occupancy of other comparable properties? We did go through this, right?
Yeah, we went a survey of comparable properties, and the average rent is $11.75, right? I think it's better to look at rent comparables and average rents in the 1 mile radius than to look at occupancy, because there are clearly reasons why occupancy is lower in some of the other properties as a whole. Now, on the properties that are more like kind, we're seeing essentially, I believe they had potentially waiting lists, or it was a bit hard to get in. And that really allows you to start forcing the appreciation of the rent, which we're not going to necessarily take advantage of until after full renovation. So the first 2 years, not necessarily projecting a rent increase.
Got it. I'm just going through the questions quickly here. What major capital improvements do you anticipate? We did talk about what we're doing with the down units, with the common area, and with the non-renovated units. Am I correct, Mark?
Yes. Yeah. So there's 2 types of capex, and one is the units that you just mentioned. The other is common area. Earlier I mentioned we have about 13 roofs that we need to replace. Painting the exteriors. We got some, there's going to be some new windows. There's going to be, if the, what's called, the gutters, some of the gutters are kind of falling off. So, there's gonna be a lot of that, and then improving the common areas as well. The park is a little old and dilapidated. The dog park is missing a gate. In the back, I mentioned that we're going to add a pergola. We're going to update the grills. So we're going to make it a nice community.
Thank you. This is again now getting into specifics. An investor asks, can you explain 1031 exchange process with a 401k possibility? Right. I think my humble opinion is, in the interest of time, my request to the investor is definitely get in touch with Eng or Ryan, and more importantly, with somebody who can advise you with this in general. So we really want to answer, but in the interest of time, can I let go of this question, Eng? Is that okay?
Mm-hmm. Yeah.
Yes, but we definitely like talking about this. Similarly, an investor is asking, can you explain the difference between a 20% IRR and 10% cash on cash? Wonderful question. It's going to take some time. Maybe we should do an educational webinar on all these metrics itself, right? But go for it, Eng. Do you want to give a quick answer on that?
I think in general, when I think about cash and cash, I love cash and cash because it's present. It's relatively more predictable. IRR comes from cash out, refinance, or sale. A little bit less predictable, but generally that's how you get the highest velocity of capital return. IRR should probably, if you're a constant investor, if you're always redeploying capital and get your money back and then investing it literally a couple days later, you should really care about IRR. That's how you're gonna, with 20% IRR, you're gonna double your money every 5 years.
Eng, what's included in the closing costs?
Including closing costs is working capital. We have several legal fees that are a little bit higher than loan origination fee, title fees, mortgage recording tax, and a lot of due diligence and tax escrow. So we're paying a lot of upfront escrow and prepaying the interest. For those who are interested, we will be providing the pro forma for anybody who might want to look into.
Yeah, I think that would be, unfortunately, it shows up as an anonymous attendee, so I don't know who it is. So please do reach out to Ryan or Eng and definitely take a look at the pro forma if you're interested in digging, double clicking and going through the details. They will all be available to you.
And I want to highlight that based on the math that Ryan told me, we're at 75% subscribed of the full 6.7 million capital with the 10 durations included. So just FYI, for anyone who's interested, I know that
now it's getting like one of those other deals that we have. We are 75, we are 85, we are done. Yes, we'll leave that. Let's try to answer the question. Super happy that it's 75% Eng for you and the team. Again, this seems to be, I think that I should take this question. Why does this purchase qualify for a Fannie loan?
Exactly.
Either one of you can take that. Why does this purchase qualify for a Fannie loan?
Well, they've already relatively stabilized it in the 70% range. In addition, the sponsors of this have a good track record with Fannie. So the combination allows us to get in with Fannie.
Mm-hmm.
The next investor is asking, can you please provide a rough approximation of UBIT for 100K IRA investment over 5 years? It's going to be a little bit difficult right now. Maybe we can get on a separate call. Apologize for that because those are very specific situations. But we can talk to Eng. He's got the time for everybody. He'll walk you through it. Sorry, Eng, for that. An investor says, pardon me if it's already answered, joined a little late today. How much does the property appraise to in the current state? What's the current appraisal of the property? Is the purchase price below current market value, or are we overpaying due to funds chasing deals like this?
Mark, did you see the latest appraisal reports?
I've not.
So we're still sorry, Chip.
Please go ahead. No, I meant to say, if the definitive answer should come, definitely look at the appraisal report, and probably it says anonymous attendee. We'll try to respond to everyone then with the answer on this one. Is that okay? Well, that was a strong question. Are we overpaying due to funds chasing deals like this? That's a strong
that's a great question. I guess it depends. If you're a long-time investor like me, everything seems like an overpay, but also capital and cost of capital and debt is always chasing yield. I'd rather make money than not make money. Rather invest my money than not invest my money. I'd rather get a nice government-backed loan, very generous loan from the government, to then get a 20% IRR on that loan. So these are all factors. I think buying right is still paramount in any real estate investment. And because of our partners' relationship with these off-market sellers, I think we are in a good position, especially with these value-add opportunity.
So there was a person who asked about closing, right? And similarly, another investor is asking, what are the management and disposition fee and also acquisition fee?
The development acquisition fee inclusive is 3% of the purchase price, which is typical for this price range of the purchase price, which is not the project cost, which is significantly higher. Management fee is 3% property management fee and 2% asset management fee for our partners, and disposition fee is 0.
Thank you. Thank you. Thank you so much, guys. Guess what happened? We just went down to 0 questions. I wanted to completely confirm if this is true, so I'm going to share something here. If people can actually see my screen, yes. I can actually, as an investor, see Maple Haven as a live offering. For people who have seen our portal, some things have changed because of the partners who we work with, I mean the tech partners. So you might see different colored buttons and so on, but Maple Haven is live. I definitely want to get a feedback on one particular thing. That's because I haven't logged in. Let's forget about that. Definitely let us know what you think about the e-signing process itself for Maple Haven. We've fine-tuned it so that investors can actually sign more quickly and more easily. So let us know, give us feedback on what you think about the e-sign process itself. Actually, a question came in, Eng, so let's take that. What interest rate are you projecting for refi in 3 years?
So actually, earlier Eng said 4.25. It's actually 4%. So the refi will be at 4%. Mm-hmm. Oh, sorry, we're projecting the refi at 4%.
Yeah, so I did log in. What I was trying to say is the whole e-sign process that you're going to see, just let us know the minute you say I confirm and next how quickly the e-sign process actually is, how many different places you have to sign. So that's something that the TOSI team has really worked hard on. So with that, we are at the bottom of the hour, an exhaustive 90 minutes. Thank you so much, Mark. Thank you so much, Eng. And thank you so much, all the investors. Let me just hand it off to Eng for his closing remarks, and have a wonderful evening, everyone.
I want to give a big thank you to all our investors. We couldn't have gone this far without you guys, and we'll be rolling out a lot more investor access exclusive deals to make sure that investors get priority, because it's all about investors. At TOSI Capital, I really think, and I get frustrated when investors don't get what I believe they should be getting. And we'll be rolling out some more appreciation, potentially appreciation event in Q4. We're looking forward to a post-pandemic world to get to see and know you guys better. But I really appreciate all you guys, and I'm very excited to offer this investment with collaboration with our operating partners. Maple Haven is a classic value-add multifamily deal. These are hard to come by, and we are very excited to execute on this business plan in the next month or so.
And in my closing request to all the investors who want to come in with 1031 exchange, it's completely up to you, no pressure. But if you so happen to be interested in this property to bring your 1031 exchange money, we do have a hard cutoff till next Friday. So my request is get on a call with Eng, Ryan, get to know more about the property, but help us out by getting in before next Friday. After that, it will be difficult to get in with the 1031 exchange. Thank you so much, everyone. Thank you so much, Mark, for all the time, for going to Atlanta, for actually visiting the property, and for doing the due diligence. Thank you so much, Eng. With that, have a wonderful evening, everyone, and hope to have this deal subscribed soon. Eng, all the best to you guys, Tosi, as well. Bye-bye.
Thank you, Chef. Have a good
Thank
night.
you. Bye.